We're recording. Wonderful. Happy Saturday and welcome to our workshop number 4, which is I'm so pleased to have you. And I hope so far it has been beneficial to you. This week, I'm going to speak about something mystical, I would say. A lot of people have heard about futures, but this is something we might see in the movies, or if you're really serious about trading, you might have tried it. It always been told it's such a risky uh, and it's an investment tool that you've got to be very careful, which you do. But it is more of a tool to guide you to do other investments. So what I'm going to do in the next 45 minutes, just want to make sure you get the gist of what it is, some of the specifics about it. So by end of our 45 minutes, hopefully you feel much more comfortable uh, looking at FinViz, understanding what happens, and how, again, as I mentioned, we can use these tools to use other investments. So I'm going to assume, again, I know some of you have been trading futures, but let's just, for the next 5 minutes, assume you have no clue what is futures and why is it actually in business. So, uh, well, let's start with this. Let's say you're a baker and you know your busy season is right around Christmas and it's April now or May or June or whatever. So you need lots of obviously flour. So you need wheat and you need sugar perhaps. So things can move up and down. Wheat price can go up depending on whether there's a drought or whether there's geopolitical problems, whether there's too much rain could go down. And the planting season is March and April. Then we have hot July, things can happen there. And then we have a harvesting in September and October. So we have this cycle. So you know, businesses like certainty. They like to know what the cost is going to be, how much they have to spend. So what this baker goes to this wheat farmer and says, listen, I will need so many thousands of pounds of flour or wheat, and can we come up with an agreement that I will pay you like $5.50 for a bushel when in November or December or something like that. Let's say November, can you deliver it? So they write a contract, they decide on an agreed price, and basically what happens, which is actually, it's not really futures, a forward contract, then this farmer knows that he sold his um, whatever the harvesting had done and the supplies, and then the baker knows he can count on that $5.50 a bushel. So the futures market actually, unlike what you think of, oh, it's so much volatility, they will go up. It brings really order to the markets, brings liquidity to the market. So the baker gives a good faith deposit to the um, again to our farmer, and then what happens is they both have some certainty. Now, with the futures market, let's say the wheat goes, it's a 550, it's $4. So the baker says, am I crazy? Well, you can keep my money. I'm going to go and buy that $4. Or if it goes to $7, then the baker has gotten in a really good price at 550. So basically, that's one of the reasons that the futures market work. Or how about chocolate? Valentine's Day, your chocolate makers, they have to have cocoa and sugar. And um, so that's one part of reasons for the start of the futures. But also, how about if you're in airline business? How about with the volatility in our fuel, the jet fuel? What do we do? Things can go up and down. So what happens, Southwest has its own storage and buys so much, but how much can they hold? So they can go into contract and say, well, we want jet fuel at this price. Let's say oil is at $60. They come out to contract. Or what they could do, they could actually go buy contracts, the future, which we will learn about it, to hedge themselves. And those are the biggest ones. The hedgers, the commercials are the big ones. And why is that? Because they can avoid the fluctuation. So let's say they bought oil at $60 today, and they have so much supply for a month, 2 months. What they could do, they actually go long, buy futures contract, which is at 60. So if futures contract goes to 70, let's say in June or July, what they have, because they have that futures contract, they're protecting themselves because although they have to buy fuel at $70 in 2 or 3 months, well, they made money on the growth or the appreciation of their futures contracts. So they hedge themselves using these futures. So you can see it's not just about day trading, which we will hear about that. It's more than that. It's mostly for the commercials. So let's take a look at the 10 largest manufacturing companies in the world. We have Apple and Samsung, and then we have a lot of car companies. And Cardinal Health, which is a big, actually, pharmaceutical producer. All of these, they need raw materials. They need, whether it's aluminum or whether it's steel, they do need that. So basically, they have to protect themselves, and that's what the futures market helps them. So in our session, these are the things we're going to go through and study or actually learn about the history, what is the future and futures contract, who are the participants, the types of contracts, the benefits and risks. If you haven't done options, don't worry, we will have a class on options, but if you're familiar with options, well, we compare them. The risk management is important. That each contract has its own specifications. Each one, there's something called ticks, which is a smaller unit of the movement, notional value, settlement, lock limits, trading hours, and the best futures brokers. So let's put on our seatbelt and go on this journey. Believe it or not, the futures have been with us since Babylonian uh, king Hammurabi. He created in 1750 BC. And basically, he said, you know what? We can sell the goods and assets, although they will be delivered in the future, but you can actually start doing it now. When we go to Roman Empire, the olives, for instance, they were futures market on olives. And basically, that's how it started. It's putting something in a legally having contract to deliver in the future. That brings the stability. When we come to the modern times, we have that, as you know, in Asian markets, rice is obviously is a big part of the food side of things. People obviously have to have rice as part of the culture. So in 1710, Dojima Rice Exchange in Osaka, Japan was open. So that's the first modern. So in 1700s, we had the rice futures. Chicago, remember Illinois, we look at Iowa, we look at Ohio, we look at Nebraska, Wisconsin, all the Midwest. That's the grains belt. And Chicago, having the rivers, became really the place that all the exchanges, the marketing of grains such as soybean, corn, and wheat was happening. So Chicago was the really first one in 1848. We had the Chicago Board of Trade. Right now we have Chicago Mercantile Exchange, which is the largest. So that's what all the lot of exchanges happen. And the financial futures, which is we talking about when we talk about financials, is the stock indices, we're talking about treasuries and bonds, and we're talking about currencies. That started in 1970s. So you probably have seen pictures or videos how the people are, you know, uh, having the hand gestures, buying and selling, all the loud noise, who's the loudest, losing their voice by the end of the day. And this is my time. I've been to Chicago Mercantile, and I remember those days I used to follow. I had a class I did on the hand gestures, your palm and your back of your hand, the numbers, what do they mean? So anyway, interesting days, but those days are gone. This is from 1930 Chicago Board of Trade. We will have the customer goes to the broker dealer, they come to the floor runnel, they go out and start buying and selling, they come back with a tape, and all the way goes back to broker. And that's how it was every day. Well, of course we don't have those anymore. Everything is electronic and it's a lot different now, so it doesn't exist, but it was fun times. And but again, very few people were familiar with it. Then it became modernized, electronic and all that they could see, but no more. And so what is the future? The future is, this is important, is standardized derivative. And what do we mean by derivative? Any derivative means stand alone, they don't have a value. It is driven from some other assets. So when you think about options by themselves, they are not. Options depend on the, let's say, stocks or assets underneath. So it is when you own a stock, when you buy a real estate, when you buy a bar of gold, you actually own it. But when it comes to derivatives, it's just it's a piece of paper. So the value of this account is it depends on the value of underlying assets. So and that's what futures are, options are, swaps are. So basically, they're called derivatives market. In this case, we have a buyer and seller. And there's this contract that it gives them, again, the legality. And there's an intermediary, which is called a clearinghouse. They're the ones, when you buy and sell your house, you put in an escrow account, there's a middle person. This is kind of similar to that. And the clearinghouse, it protects the potential liability. It keeps the buyer and seller in check. And there's always mark to market on it, almost the lease is like on a daily basis, sometimes twice or three times. So there is the settlement at the end of the day, but sometimes doesn't have to be end of the day. For instance, the gold settles at 10:30 a.m. our time, which is 1:30 uh, um, East Coast time, New York time. And that's when the buyers and sellers, the books are settled. So by the end of our sessions, hopefully we will have an 11th session. I will talk about some of my strategies. You see that 10:30 a.m. is a big volume jump in gold. So that could be a good strategy to understand, um, you know, buying and selling gold, for instance, just using that. So yes, so that's what the clearinghouse does. So in the futures contract is there's two parties and the contract is guaranteed to be honored. So what is written there? The size of the contract, the grade, and let me explain what the grade means. It's like I hope you've had a chance to look at some of the videos I sent you on commodities. So for instance, we have different kind of crude oil. We have sweet and we have heavy. Well, the WTI, the Western Texas Intermediary, is different than what we get from Saudi Arabia. And so they all are different. Sugar, we have number 13, number 11, we have coffee, Arabica. So each one has to be, again, spelled out. We also have delivery month. Contracts don't have like stock, you can hold it for 30, 40 years as long as they don't go bankrupt. With contracts, you have a limited time. So they keep moving from, again, depend they expire, the dates expire, like options. But also we have, if they have physical, we have delivery location. So for instance, if I bought wheat for that's what, well, where is it going to be delivered? And we will see that there's a two different, there's a physical and financial side. So that has to be returned. And again, the only thing is the negotiation is just a price, which keeps moving. So when you get a futures contract right now, let's say, oh, I'm so excited. I got this. I want to start trading S&P futures or corn futures. Well, there's a few things you have to remember. There is a margin requirement. Remember, the beauty of futures is you don't have to buy a 5,000 bushel of corn or wheat. You put this, again, good faith deposit, and so it shows that you're committed, and then it's settled later. So it's a very small margin. And that's what it is, the attraction of futures, because with putting in so little, you can control so much. And because of that, if things go your way, you can make a lot of money. And if it goes the other way, well, you got a lot to lose. And I have war stories that I can share. That's why you have to be careful, which I will share a little later. So there's a margin, and that margin is like initial margin during the day. If you started and you closed during that hours, that's all you need. But if it goes overnight, which is like if it's 2 in the afternoon, the markets close in West Coast time, or 5 in the afternoon in New York, everything opens at 6 o'clock. If you did not close your account and it went to the next day, that's called maintenance margins, which is generally 3 times initial. You have to have it in your account if you want to be able to continue, buying and selling. And then we have margin call. What if your asset investment is keep going down? Well, your broker can come and say, listen, you're below this maintenance margin. Either you have to put more money or we're going to liquidate. So these are important things to remember. So who are the players in the derivative markets? Again, all you hear is traders, the speculators make so much money. Well, the biggest ones are the hedgers, the commercials, the ones that we talked about, airline companies or auto companies. They are the ones who have to protect themselves, the food companies. Then we have speculators who, the whole goal is to make profits in and out. But also the big ones are the arbitragers. The arbitragers, they use because there's so many different exchanges, they look at the anomaly or the disefficiency of the pricing. So just could be 1/100th of a penny, for instance. But they do such a large volume. If there is, let's say, an exchange of British pound to US is a price here, but if I go to London, if I go to Singapore, the difference could be a little bit more or less. What I do, I buy here and sell there, and I pocket the difference. So that's called arbitrage. Other one, which is actually very good, if by the time we're getting more expert, the spreaders are, we will discuss this a lot in options. That's what you want to be really expert, is limits your risk, but also gives you still a good potential of profits. You could also do the spreads in futures. And there's 2 ways really, what does that spread mean? So let me explain so you have a little more familiarity. Let's say you love precious metal. So you know gold is going to go up, but also you think that's, what if I'm wrong? Silver generally follows gold. Now, I would say silver is the child of marriage of gold and copper, because gold is really precious metal, not much in industrial. Copper is purely industrial, very economic driven, cycle driven. And silver has a lot of industrial use, whether it's dentistry, used to mean the photo, in cars, we use it, in all kinds of different products. So basically, it follows partially with gold, but also partially with the global economy. So what you could do, let's say if the gold doesn't go up, instead of just buying gold, what you do, you buy the gold and then you short silver. That means you go opposite. So what could happen? Well, if gold goes up, you make money, but you lose money on silver. But if gold goes down, well, you make money on silver. So you don't make as much money, but you don't lose either. So that's called spread. We will do that, for instance, with corn and soybean, because usually the fields, they move from one to another. If the corn is really doing well, people, the farmers move from corn, from soybean to corn, the opposite. So you could go long corn, or you can and short soybean, for instance. So the other part is in spread is not just the assets, it could be the time. We have seasonality in gold. So what you could do, you can buy September gold and then sell December gold, because what you've learned that markets start moving in summer in gold, and then they start peaking out in December. So what I'll do is you can spread it that way. And again, you can basically protect yourself uh, by paying a little bit for hedging yourself. There are so many different exchanges. We all know about CME, but in Asia, like we have the Dalian in Tokyo, and in Europe, so in South Africa, South America, we have in Middle East now, especially second largest, like we talk about Dubai, and we even Iran was opening one futures market. Um, so basically, the beauty of the futures market is that you have different underlying assets, and that's what I want you to pay attention to it, because it could be agriculture commodity, it could be metal, energy, financials, and foreign currency. So they are all coming from different assets. So basically, as I mentioned, that's what they're called derivatives. And as I mentioned, there's two types. One is called financial futures, which is the stock indexes, currency, and interest rates. These you don't, they're not physical, so they are settled in cash. What that means, when the, let's say, contract ends, you settle it. Nobody comes and pours in contracts of S&P 500 in your front door. But then you have physical. And with the physical, it happens a crude oil or natural gas or metals like gold, or agriculture like corn or soybean, softs like coffee, cocoa, sugar. Now, these you actually have physical. If you forget, for instance, one trader had done it, the broker will call you 2 or 3 days before. So here I am, I bought 5,000 bushel of corn, and I forgot to settle it. I just have the margin and it's going up and down. Well, I don't want to wake up and see these trucks loads of corn in front of the yard, and they're asking for the money. So basically be careful with that. But these are the ones you actually get delivered. That's another reason. This is from yesterday, and that's why I like you to look at Finviz, the future side, every so often, every day, in the morning and after the markets close. Remember, the markets are open about 23 hours a day. So you can get a story. So now you have indices, you have energy, you have bonds, and you also have meals like the livestock, and then you have metals, softs, such as orange juice and coffee and cocoa and sugar and cotton, grains, including oats, and then you have currency. So in one place, you can actually see what is happening with all these assets. Now, you don't have to trade this. I just want to understand they are, I will do, probably send you the video, is what are the exchange traded funds. These funds follow these commodities and futures markets. So you can actually invest in them. You can buy options on them and limit your risk. So, but it's good to be familiar with it. Now, if you press on top, they're like, if you want to see how the charts are looking for, let's say, soft, how's cocoa doing? This is as of yesterday, or cotton, or orange juice, or coffee. Well, in one place, you can see, and now that you've learned a little bit about the technical analysis, make a decision. Well, is this a good time to get in? Or how about if I look at over 5 years, what happened with lumber, for instance? Or how about metals? And again, you can have access to that. So what are the benefits of trading in futures? Well, number one, Stock market closes at the cash closes at 1. We do have extended hours for some of the major stocks, and it goes on for a couple of hours, or we have extended hours before the market's open. But this thing is open 23 hours a day. So you can't sleep at night and you're in pretty good mood and you have analyzed things. Well, it's midnight, 9 o'clock, uh, uh, or midnight in New York, 9 o'clock. We do have a gold. Actually, I have three strategy gold plays. If you can't sleep, Asian markets love their gold. So 8:30, 9 o'clock, perfect time, West Coast time to play some gold. So that's the beauty of it. The other thing is you can have options on the future. So with having futures by themselves are very volatile. Obviously, there's margins. You can actually use options strategies on crude oil, for instance, and limit your risk and play different strategies, which you will learn. And you have, again, different asset classes. It's not just stocks. You can do so much. Look at what's happening to gold, for instance. What happened to corn and soybean last few days. So you have all kinds of alternatives. Of course, the risk is the leverage. That's the beauty and the big double-edged sword. Because by little money, you can actually lose a lot. So I just share one story. I might have done it before, but I did have, I would go, every weekend we have these parties and people always talk about, nobody talks about how bad things are. They always talked about how much money they've made. But I did have this, a surgeon friend, and in 2000, during financial crisis, or was it 2011, he was betting, he bought crude oil futures, was $100, and he kept betting uh, that it's going to go down. And crude oil kept going up. So he kept buying more. So remember, there's leverage and there's these margin calls. And so he kept getting calls. So what did he do? He mortgaged the house. Beautiful house he had. Well, oil did go to 147. So needless to say, he lost his house, he lost his wife, and he's just building now. So that's the negative side. You have to have absolute, absolute, absolute sound risk management. There's a lot of, again, temptation because it's so easy. The same thing happens with Forex. Everybody loves Forex. I know 85-year-olds in Japan, they trade Forex. The thing is, it is about leverage. It's just so attractive to open an account with $200 and thinking, oh, I'm going to make 100,000. So basically, that's temptation. Contracts expire, so remember, every futures contract has its own expiration month. So we will go over that. Trading futures comes with a various specification, which we will also learn about that. So why do we like to follow S&P futures, which is the one that I do the most, is because it's market efficient. It's very tight bid and ask. So it's very inexpensive, getting in and getting out. Obviously, the leverage, no pattern day trader, because people who come on, if you have under 25,000 and you're a stock trader, uh, basically you can only do like 3 trades a week. With this, we got $2,000. If you do like micro, you can go in and out. Nobody questions you. Obviously, tremendous amount of liquidity. The taxes, I will talk briefly about the taxes, very attractive for futures. As I mentioned, open 23 hours a day. Friday at 2 p.m. West Coast time, it closes. Open Sunday evening at 3 p.m. No interest charge for day trading. You do have margin. So even if you borrow for stocks or, if you have an overnight Forex, you might pay interest or get interest. This one, there is no interest charges and it's done all electronically. So let me just briefly, if you are really want to go into futures market, there's a 1256 contract. With stocks, if you hold it under 12 months, you have to pay ordinary taxes or short-term taxes, which is based on your tax bracket. With futures, if you hold it, the shortest time I've held my futures account is 6 seconds. So whether you trade 6 seconds or 11 months and 20 days, 60% is long-term capital gains, 40% is short-term. No track of trades. I used to do for my clients, it's tax season now, we would have 500 or 600 trades sometimes. And I had many clients, I would do it for them, Schedule D. And one by one, when did we buy it? When did we sell it? Oh, how much gains we had? What was our basis? No, with futures, you get a 1099-B. One line. It says on January 1st, for instance, you had 10,000. December 31st, you had 20,000. Thank you very much. You have 10,000 profit. That's it. You take it to your accountant. That's all they do. One line. Each line is like $45 or so. So here you're saving a tremendous amount, but the simplicity, right? And also with the losses, you can adjust it up to 3 years. So back. The futures versus options quickly, it's again, both are standard contracts, but the risk with futures is very high. If you're a buyer of options, and we will learn a lot about options, it's only the premium that you paid. You're at risk. Nobody's going to come ask you for more unless you're a seller. Buyer's obligation in the futures, they have to execute the contract, but there's no obligation when it comes to, you can just walk away. The sellers have to complete the obligation, and if the buyer chooses, then the seller will have to abide by it. So if they're again, that's called, exercise. Payment in advance, there's really very little margin. There's no that much payment. It's just a premium. Um, Gains and loss, sky is up it's not, the sky is the limit, because most people, that's how they lured in with options and futures, because there's just so much leverage. And basically, risk management is the key. And we will talk about risk management in a separate class on position managements. If you go, this is Thinkorswim. If you go top, it gives you all the specifics. When you look at the futures, tells you exactly what they are. This is just a micro, which I will discuss it. Actually, I will discuss a little later how the micro works. A tick size, a tick is the smallest possible price change. And what I mean by that, let's say in S&P, it's $1 move. So if S&P is 4,000, goes to 4,001, that's 1 point move. That 1 point is $50. So if I bought S&P at 4,000 and sold it at 4,001, I made $50. But that $50, that 1 point is divided in 4 quarters, or it's like we call it a tick. So the smallest tick, or the smallest portion of S&P is 0.25. What that means is S&P will move 4,000 to 4,000 to 0.25, 4,000.5, and each one of those are 1/4 of 50, which represents $12.50. Now, in crude oil, $1 is worth 1,000. So if you go from 60 to 61, you make $1,000. But it moves in pennies. So it's $60.01. That 1 cent is $10, or again, 100 of 1,000. So basically, if you go from $60 to $60.10, you made $100. The same thing, it happens in gold. Gold is every dollar is 100, and it moves in 10. So it's like the penny. Is it like we go 10 cents is $10. So it moves the tens. So it's like $20, $30, up to then $1 is $100. So the smallest, again, fluctuation is called a tick. So like in Dow Jones Industrial, it moves $1 at a time. So it goes from 43,000 for 43,001. Well, that's $5. In ES, which is S&P 500, it moves in quarters, which is $12.50. Crude oil moves in pennies, that's $10, and so on. So like NASDAQ moves in quarters, and that's like $5. There's again, I don't want to bore you. In the interest of time, let me just go through. There's a sugar, there's like a different grades. This is your reference right here, so you can print this out if you like. And so it gives you every specific, every the symbol, because every stock futures have their own symbol. Indices is like S&P is ES. You notice like in my trade was ESM, which stands for the month of June, and 225, which is 2025. So there are the tick size, the tick value, and each broker has its own initial margins. So it depends on what you are, who you're working with. So if they're conservative, cautious, they will ask more margins. Notional value, basically that tells you how much you're controlling just by, again, this future markets. And the way you calculate, remember, every point is $50. S&P last week was at, let's say, hit 5,100. That one contract that you buy controls $255,000. That's the beauty of this and also the danger of it. Just a few examples here. This is of 2021, just the size of, different futures markets, or, energy and agriculture. And this is not Forex, this is the currency futures. But you see the interest rates are at 3.8 trillion. They're 6 times almost the size of stock market. So learn about that. And as I mentioned, the specification, each futures contract has its own. For instance, S&P and all the financials like treasuries and NASDAQ and currencies, they have their own, but like S&P, like indexes and stocks, they only trade it 4 times a year. So we finished March, which was H. Now we are in M, it's June. Once this expires, we go to U. So there's going to be like rolling. We call it rollover. So if June ends, so on June 20th, everything is going to be rolling. So it's the last day. So the third Thursday. So the 13th, we start rolling to the new account. So ESM25 will move to ESU25. So basically, that's how the rollover happens. The trading hours, again, these are more of a reference for you. As you can see, almost everything, major ones, they open at 3 p.m. West Coast time. They close at 2 p.m. West Coast time. And the only ones that they don't, so the metals, these are central time, so it's the same as 3 o'clock West Coast time. They open the trading hours for energy. The only ones you have to remember, grains, they have their own system. This is central time. So about 11:20, about 11:15 to 11:20 a.m. I don't do as much. The markets go crazy because they start again. That's the closing time. So if you had a USDA report, I think they go crazy. So again, these are just for your own records. The softs, the same thing. They have their own hours. Currencies, the same, like indices, the stock indices, livestock, forest. And then I just put the holidays here. You can remember 24 hours almost a day. In Asia, the markets are open. So even though we have holidays, there are some still open. But in the United States, let's say sometimes we just close at 10 a.m. rather than continuing. So it probably closes maybe 6 or 7 hours the most. More specific, one thing you have to learn, there's something called micro. It came not long ago. It's 1/10 of the regular E-mini. Every time you see M in front of a symbol, that's micro, which is 1/10 of the price. So I'm going to share that with you. So if there was AES, now it's MES. We also have it in crude oil, and it's only 1/10. So remember, one contract of S&P was 50, with M is 5. Remember, the $12.50, the smallest tick, is $1.25. So a lot of smaller traders can start testing their strategies with not putting too much obviously risk at work. So if my surgeon friend, if he had the micros, perhaps he would have kept his house. So he still would have bet on oil going up, but it will be 1/10 of the risk. But it's the greed, right? We will discuss about that. And so you can see we have micro Bitcoins now. We have micro Ether. So instead of, again, it's the $5.50. So, and I just want to understand these lock limits. We did hit it actually in S&P futures. I remember in COVID time, if the markets drop 7% and then the markets take a break, it's a breather. Let's just settle and just breathe. Um, the same thing happens in corn when they drop, or the agriculture. The exchanges stop it, whatever time is, take a breather. The next day, again, they want to make sure there is sanity, because when emotions come in, the sellers are just so nervous they keep selling. So that's why they have these rules. So remember that. We saw that during the COVID. And I do have lock limits again as a reference. Just a little more information. Um, the last thing I have to say, these are, as of 2024, the best online brokers. Interactive Broker, E-Trade, Charles Schwab, which has the Thinkorswim, Tasty Trade, and TradeStation. These are the top five. I'm sure you have a lot more, whether you use NinjaTrader or whatever, but this is the top comprehensive ones. So one thing is, again, if there was any complaint about your broker or there was something happening, well, we have the CFTC, Commodity and Futures Trading Commission, and NFA, National Futures Association. They oversight and enforce the laws. So for your homework for next week, I mean, it's not a homework, but hopefully it's a fun thing, is if you like to really get into how the futures market work, this is one of the funnest movies, comedy, I believe it was 1984, Dan Aykroyd and Eddie Murphy. And the gist of it, I can tell you, so you can feel how the markets worked. And this was, I think it was the orange juice futures. So the movie is about two brothers, and those two brothers are betting $1, by the way, that is trading. Do we learn? Is it nature versus nurture, or is it inherited? And we have the successful trader, Dan Aykroyd, coming from wealthy family, all his are educated and all that. He's so successful. So they find Eddie Murphy is a homeless to grab him in New York, and then um, I was in Chicago, but yeah, it's Chicago, I think. So they grab him and they teach him and ask him to teach. So they fire him, and the story goes on. Now, there's a little truth about this. If you know Richard Dennis, one of the most successful traders ever, he and his partner, they were a brother, they made a bet, nature versus nurture. Richard Dennis was saying that we can teach, and that's what my whole goal is with our group. Hopefully I can share some of my knowledge so you can be more successful. So he came with a system called Turtle Trader, and I believe he used like 30, they say 100, but 30 of them. Only two left. The rest became multimillionaires. So his idea was we can teach. And that's the end of that. So with that in mind, I hope that was useful. And I'm going to stop the recording, and then we can get to, if still with me, get to questions and answers.